Markets celebrate the mythic trader who calls tops and bottoms with prophetic precision, as if clairvoyance rather than discipline writes the equity curve. This seductive fantasy destroys more capital than any single force in trading, flattering the ego while promising instant mastery. Richard Wyckoff rejected that spectacle entirely. He refused to predict and chose instead to verify, treating the tape as evidence rather than prophecy, demanding that price and volume confess their intentions before he risked capital. Wyckoff understood that prediction feeds hope, while verification preserves wealth. His methodology centered on observable phenomena, the measurable shifts in effort versus result, the structural patterns that emerge when smart money accumulates or distributes inventory. Where amateur traders chase headlines and hunches, professionals wait for the market to reveal its hand through concrete, testable criteria. This represents the fundamental chasm between consistent profitability and chronic frustration. The master observed that genuine reversals never arrive as clean invitations. The composite man manufactures one final act of deception, making strength appear as weakness or weakness masquerade as strength, ensuring public orders supply his inventory needs at optimal prices. These terminal maneuvers create the very opportunities that disciplined traders recognize through systematic analysis rather than emotional reaction. Wyckoff's 5 signs transform this deceptive landscape into readable structure. They encompass stopping action that halts prior trends, character changes that reset market rhythm, and verification through controlled retests on diminished effort. When these elements align around defined danger points, risk compresses while reward expands asymmetrically. The goal becomes not prediction but recognition, not being first but being right when positioning matters. Mastery emerges through patient observation, letting cause become effect, while the crowd capitulates at precisely the wrong moments. The law of effort versus result stands as the governing principle, underlying every reversal Wyckoff acted upon, serving as his compass through the market's deliberate deceptions. Volume represents the market's effort, the visible expenditure of energy, as participants transact with varying degrees of conviction and urgency. The result manifests through price spread, velocity, and net progress achieved by that effort. When substantial effort produces minimal result, the tape reveals absorption as smart money, systematically opposes the current move, taking the other side with the patience of institutional capital building or liquidating positions. Wyckoff observed that this asymmetry appears as handwriting on the tape, not random noise but deliberate disclosure by the composite man who cannot announce intentions yet must transact in size, leaving measurable footprints in volume and price action. Climactic, effort-producing diminishing progress signals stopping action, where massive volume accompanies narrow spreads and limited net advancement. The market labors intensely like a freight train meeting a hidden grade, yet achieves little, suggesting that every seller finds a willing buyer or every buyer encounters determined supply. This absorption represents professional money, methodically accumulating or distributing inventory, while emotional participants provide liquidity at precisely the wrong moments. The inverse phenomenon proves equally revealing and more immediately actionable. When modest effort generates outsized results, sudden expansion in spread and speed during counter-trend waves indicates fundamental shift in the path of least resistance. These movements catch participants off guard precisely because they require so little apparent effort, suggesting that resistance has evaporated and the underlying supply-demand balance has fundamentally altered. Professional traders translate these observations into objective measurements, comparing upwave and downwave spreads, analyzing bars per leg ratios, and examining relative volume at critical turning points. When effort consistently exceeds results in one direction, while minimal effort produces substantial results in the opposite direction, the tape confesses its intentions through measurable phenomena rather than subjective interpretation, providing the foundation for recognizing genuine structural shifts before they become obvious to the broader market. Stopping action emerges when climactic effort meets an immovable wall of opposing orders, like a river encountering a dam and churning without forward progress. Wyckoff recognized this as the market's confession that a prevailing campaign had exhausted its natural supply or demand. In accumulation, preliminary support absorbs the first wave of panic selling, followed by a selling climax where volume erupts, yet price spread contracts relative to the effort expended. The automatic rally develops as this absorbed supply vanishes, permitting natural buying to lift prices with surprising ease. Distribution mirrors this sequence through preliminary supply, buying climax, and automatic reaction, each phase revealing how professional money exploits public emotion to facilitate large-scale inventory changes, while effort consistently exceeds results. From this foundation, change of character provides unmistakable confirmation that market rhythm has shifted fundamentally. Countertrend movements begin to exceed prior legs in spread, velocity, and conviction, displaying urgency that contradicts established patterns. Where reactions previously compressed and impulses labored, volatility now reorganizes with expanding moves in the emerging direction and contracting moves in the old direction. The tape changes key as the path of least resistance abandons its former allegiance, creating measurable asymmetry between opposing forces. The quality of the test transforms promising structure into actionable opportunity through controlled verification. Secondary tests revisit danger zones on demonstrably diminished volume, narrower spreads, and hesitant momentum, deliberately failing to establish new extremes. Superior tests frequently print narrow range bars suggesting no supply after selling climaxes or no demand after buying climaxes. The composite man probes for remaining inventory, and when little appears, the market reveals its hand through this disciplined re-examination. These tests convert attractive theory into evidence-based opportunity, providing defined risk parameters while confirming that apparent weakness conceals underlying strength or apparent strength masks fundamental exhaustion. The terminal maneuver arrives as the market's most calculated deception, a deliberate trespass against established boundaries designed to convert public certainty into professional opportunity. The spring in accumulation penetrates support with apparent conviction, triggering protective stops and inviting fresh bearish participation precisely when smart money requires final inventory at optimal prices. This violation appears decisive to emotional participants, yet proves ephemeral as demand immediately reasserts itself, reclaiming the breached level with authority that reveals the penetration as engineered bait rather than genuine breakdown. Distribution mirrors this through the upthrust after distribution, where resistance yields momentarily to seduce late buyers before supply overwhelms the advance, trapping optimistic participants at the precise moment when professional money seeks to complete its distribution campaign. The validity of this terminal maneuver crystallizes through its test, manifesting as a controlled revisit to the violated level on markedly diminished volume and narrower spreads. This retest demonstrates that the false break accomplished its purpose of clearing remaining inventory and positioning, leaving insufficient fuel for continuation in the direction of the original violation. Where genuine follow-through would have appeared with conviction, only hesitant motion emerges, and this absence of commitment in the old direction becomes information that the tape cannot conceal. From this foundation, signs of strength or weakness materialize as the market reveals its true intentions through asymmetric wave characteristics. Demand asserts itself through expanding up waves and contracting down waves, while supply dominates through decisive downward movements and feeble rallies. The backup to the edge of the creek follows as the market stages one final controlled return to the breakout hinge, printing the last point of support in accumulation or last point of supply in distribution. This represents the danger point where risk compresses into defined parameters while reward expands asymmetrically, offering professional entries with clear invalidation levels just beyond the failed spring or upthrust. Execution becomes systematic around these confluence points, entering where information density reaches its peak, and scaling only as structural confirmation accumulates, transforming speculative impulse into disciplined campaign logic. Even when the tape speaks with crystalline clarity, traders often cannot hear its message above the cacophony of their own emotions, creating a tragic paradox where recognition fails to translate into profitable action. The invisible saboteur operates through three distinct psychological archetypes, each representing a different manifestation of how human nature subverts otherwise sound analysis. Hope arrives first, disguised as courage, and seduces the knife catcher into purchasing during selling climaxes, as if bravery could substitute for verification. This trader mistakes violence for value, confusing the cathartic release of panic selling with genuine capitulation, while ignoring Wyckoff's fundamental requirement that stopping action must be followed by automatic rally and secondary test before positions become justified. Fear manifests through the breakout chaser, who becomes intoxicated by initial strength after recognizing change of character, yet remains blind to the pending spring or upthrust that will separate weak holders from their capital. Headlines and momentum create artificial urgency that overwhelms systematic process, transforming careful recognition into impulsive reaction. This trader buys the first expansion bar, becoming liquidity for the composite man's terminal manipulation, rather than beneficiary of the subsequent markup, mistaking activity for progress, when the most dangerous moves often appear most convincing. Pride proves most destructive through the revenge trader, who argues persistently with the tape while anchoring to prior analysis that once felt correct. This archetype adds to losing positions under the delusion that persistence equals discipline, confusing obstinacy with conviction, while the market systematically dismantles flawed thesis. Each doubled position represents not courage but capitulation to ego, as emotional attachment to being right overwhelms the objective evidence that accumulation has become distribution or strength, has revealed itself as engineered weakness. These behavioral patterns gain reinforcement through predictable cognitive biases that distort perception even when structural evidence remains clear. Recency bias weights recent price action over established context, causing traders to treat distribution rallies as genuine strength or accumulation shakeouts as fundamental breakdown. Confirmation bias narrows the field of vision until only agreeable signals appear, while contradictory evidence becomes invisible or rationalized away. Loss aversion transforms defined danger points into emotional anchors that must not be violated, preventing proper risk management and causing stops to migrate as positions metastasize beyond reasonable parameters. Wyckoff understood that successful tape reading demanded emotional neutrality, treating market action as evidence, rather than personal vindication or challenge. The antidote proves procedural rather than inspirational, requiring pre-commitment to systematic criteria that govern behavior when emotions would otherwise rule. Discipline becomes policy through written if-then statements that demand stopping action before entry, insist on change of character to prove regime shift, and require clean tests to validate terminal maneuvers. The danger point serves for risk definition rather than ego anchoring, allowing recognition to replace prediction while structure governs execution, transforming the composite man from mysterious adversary into disciplined force, whose campaigns become readable through patient observation rather than emotional interpretation. Integration transforms scattered recognition into systematic campaign logic, where the 5 signs converge through measurable confluence rather than hopeful interpretation, creating a decision framework that honors evidence over emotion while protecting capital through defined parameters. The sequence unfolds with mathematical precision, as stopping action reveals that prevailing trends have exhausted their natural fuel through climactic effort, producing diminishing results, followed immediately by change of character that demonstrates fundamental shifts in market rhythm, where volatility reorganizes and the path of least resistance abandons its former allegiance. This foundation requires verification through secondary tests that grade the sincerity of apparent reversals, probing danger zones on diminished volume and narrower spreads, while deliberately failing to establish new extremes, converting promising structure into evidence-based opportunity. The terminal maneuver arrives as the market's most calculated deception, engineering springs in accumulation or upthrusts after distribution that penetrate established boundaries with apparent conviction, triggering protective stops and inviting wrong-way participation precisely when smart money requires final inventory positioning at optimal prices. These violations prove ephemeral as demand or supply immediately reasserts itself, reclaiming breached levels with authority that reveals the penetration as engineered bait rather than genuine breakdown, while subsequent tests of these violated levels on markedly diminished effort demonstrate that false breaks accomplish their purpose of clearing remaining emotional participation. From this foundation, signs of strength or weakness materialize through asymmetric wave characteristics, where expanding impulses meet contracting reactions in the emerging direction, culminating in controlled backup action to the edge of the creek that prints the last point of support in accumulation or last point of supply in distribution. This represents the danger point where information density reaches maximum concentration, while risk compresses into measurable parameters, transforming speculative impulse into systematic opportunity, with clear invalidation levels governing position sizing and execution timing. Wyckoff's profound insight crystallizes through this integration, where prediction flatters the ego, while verification preserves capital, and patience proves an asset rather than delay in capturing the middle of lawful moves. The composite man operates through disciplined campaigns that leave measurable footprints in price and volume, transforming from mysterious adversary into readable force, whose intentions become apparent through systematic observation rather than emotional interpretation. Mastery develops through consistent application of these principles, recognizing that structural patterns repeat because human nature remains constant. Yet successful trading demands continued study of market context while honoring danger points as sacred boundaries rather than negotiable suggestions, allowing cause to become effect through measured preparation that treats the tape as evidence rather than prophecy.